Another $10,000 week in the books. Now, depending on how you trade the systematics or which systematics you trade, that of course will vary depending on your account size and how you are trading with us. But one of the things that I did want to talk about this week is just the crazy amount of volatility that we've seen. Now, last week I talked a little bit about standard deviations and how we have just had these massive moves in the market, and that persisted going into this week. Thankfully, our overnight trades and our other systematic trades have continued to do really, really well. And part of that is because of the function of how multi-leg option strategies work. Now, when you're trading shares, you don't ever have to worry about volatility as a function of the value of how much money you are or are not going to make. You are really concerned about volatility and how it might impact the directionality of the shares that you are holding. Because you always have this impression that, okay, if I bought 10 shares at $10 and the price moves down to $9, I am going to be negative $10. But when you are working with options and when you're working specifically with multi-leg option strategies, sometimes having a really high spike in volatility, in spite of having a negative price response, you actually end up with a very you can still end up with a positive return on your trade. So there's never going to be a situation where you hold shares, the price drops against you, and you still make money unless you are short shares. But if you were long shares and the price moved against you and you don't have any other hedging opportunities around it, you are just going to lose money. But with multi-leg option strategies, you can use VIX, or you can use volatility, I should say, in order to make sure that even when the volatility is climbing and you don't get the exact price action that you are expecting, you can still make money. So let's talk about it. All right, let's look at our option strat. So one of the key things is that, you can see during the week that we performed well. We did have a very difficult day on the 31st. The good thing was is that on the 31st, all of our trades were manageable. So the trades did not start red and stay red the entire day. Upon entry, they actually did. They were doing quite well early on in the trade, and you did need to manage them. So the rest of the trades, you could have just opened them and then let them kind of do whatever you wanted. But in fact, the rest of the trades did need you to do a little bit of management. And when you're in such a high volatility market, you do need to expect that. You do need to realize that, like on this day, you can see that the trade actually went up to 35% return positive and then ended 40% negative. So, of course, at any point in the day, you had more than 3 hours to exit this trade green, or 2.5 hours to exit this trade green. So you would have had to manage the trade. Now, usually what I tell people is once you're about 20% in profit on any of your iron butterflies or long butterflies, well, with long butterflies, we're looking more at like once you get to 100% return, put in some stop profits. A stop profit is where you create a stop loss that actually gets you out green so that you're not having to like stay glued to your charts. Because, a big part of doing systematics is that you have rules about exactly what time you're going to get in and when you should be getting out once you hit some certain price levels. So you don't need to be staring at the chart the whole day. That is obnoxious, and no one really wants to do that. Another aspect is that not all of our systematics are 0 DTE. Actually, only one of our systematic trades is 0 DTE. The rest of the systematic trades are actually more bent towards weekly trades. So you just need to know which day we're most likely going to enter the trade for the next week or the next 2 weeks, and then be ready to come into the Discord and be able to start those trades. Because a lot of the members are looking to make, let's say, $2,000 or $3,000 a week. That's sufficient for them. They're not looking to make like career making money. They're looking to make a couple $1,000s a week that can sustain them so that they're not, moving into their retirement funds or something. And that really only requires one trade. You can do that every single week with our double diagonals. And so, people know that approximately when during the week we're going to get into a double diagonal, and then they can stay in that trade until the following week. And that trade is going to give them a couple $1,000. Now they can scale it up and say, okay, I'm going to do 2 double diagonals so that they guarantee that they hit their profit target week over week. Now, for others, they want to be more active. They want to be making that like career changing level income on their trades. So they do need to be trading then a broader range of trades, because one of the things, though we trade a lot of SPX, we do want people to have time diversification. If all of your trades are zero DT, then they're all correlated to each other. There's no way that you're going to be able to, within like a matter of 6 hours, have any kind of diversification on your trading preferences. But if you are looking at trading something that's 2 weeks out, 3 weeks out, 1 week out, and then you have a trade that's maybe one DT and then a zero DT, having that combination of trades allows you to be able to manage your trades differently. And depending on what their exposure to volatility is, will also give you a different kind of diversification. So we try to encourage our members, even if one systematic trade has a 90% win rate and it's doing really, really well, it's okay to start thinking about adding on some other trades that also have a 90% plus win rate. Why? Not because we want you to be spreading yourself thin, but because we don't want on one really bad week where like something just goes really, really wrong, that all of your trades kind of like you're in one trade that blows up big and you don't have any other trades that are making any money for you. But if you have a string of trades, 3, 4 trades that all have a really high win rate of over 90% and they have good returns to them, then you give yourself a little bit of cushion day over day that, okay, my weekly trade is doing really, really good. The zero DT didn't do as well, but my one DT did great. And then you have this time diversification. Now, again, one of the things I was mentioning before is the function of volatility. So one of the things that people thought was really, really crazy, and this isn't going to show you very perfectly because we've already closed the trade and it's not going to show you the full information. But if you look here at the details, this trade on April 2nd, so that was on Friday, this trade returned us 88% decay. So on anything where you are selling to open, the maximum amount of money you can make is potentially 100%. And here we got an 88% return. So I want to show you what that looks like on the chart. So let's just go look at the S&P. Now remember that the center strike here is at 65.75. So where are you, TradingView? All right. So this is SPX 500 on this side, and which is the SPX when it trades, but it shows you the all-night cash values, and then this is the normal SPX. So let's go down to a 15-minute chart, and you can see that on the first, we entered a trade where the center of our butterfly, iron butterfly, was right here. Then on this, that expired on the second. So it was a 1DT trade. And then the trade drops all the way down here. And it looks like, oh my gosh, we are just going to be red. But in fact, the trade was not that red. It was red by a couple $100. Now, a couple $100 might sound like a lot, but think about it in relationship to the value of the trade that we were in. We sold to open this trade for over $6,000. So we received $6,000 in credit when we opened this trade. So in fact, the fact that you're that at the very open of the day, when the S&P is down over 100 points, to be down just a couple $100 likely means you just got to be a little bit patient. And the only thing that we needed to be concerned about is the S&P coming back to our central area, which was up here? And in fact, you can see that less than 15 minutes into the opening trading hour, the S&P started to make a move back up. And so quite quickly, we knew that this is actually potentially going to be a really solid trade. Now, I did tell people, if you are worried or if you are concerned, then, when this trade goes to break even, you can always get out because maybe the risk is a lot for you. Maybe you've only been trading, this particular systematic for 1 or 2 weeks. And so, you don't need to end up, taking some kind of loss. So you can manage this trade, get out for break even, have a really wonderful long Easter weekend, and then come back. But for many others, they felt a strong conviction that the S&P was going to squeeze right back up into the gap and that we would just end up closing it. And that's exactly what the price action did. And the people that stayed in that trade obviously did very, very well. Some of the members actually stayed in the trade until the very end of the day because of the fact that we were so close to that central area and they were able to hit that massive return. So for their privacy, I won't show their personal, because sometimes people will put in the private Discord their wins, but they don't put them in the public section. So I do want to respect everyone's privacy. Now, one of the things that I think helped people keep their conviction that it was possible for us to retrace this massive gap is that we did talk about the fact that the S&P was likely on that massive negative drop, that it was very likely for the S&P to squeeze back up and pull back into the supply zone above us. And that is exactly what the price did. Now, of course, on the very negative news from Trump on Wednesday after the close, we did see that the price of the S&P collapsed into the Thursday open. But because so many options had been positioned for an ongoing long move, we started to see a lot of squeeze right back up to the upside, and the whole gap was taken back on the Thursday. So that kind of like crazy price action can give people a lot of anxiety about trading because it works out really well if you're on the right side of the price move when you get those fast squeezes that barely last. I mean, if you think about it, this squeeze lasted from 9:45 to 10:30. So in 1 hour, we moved over 100 points. So if you don't trade that morning open candle and you're not used to trading that morning volatility, then of course you can end up in a situation where you end up missing the massive move and then are trying to trade while there's a lot of digestion post that move. And if you don't know how to trade strategies like iron condors or iron butterflies that benefit from price staying within a very particular range, then that price action would have been really difficult, or you would have had to be taking a lot of scalps in order to make your money. But because of the way that we are trading, even when you have a lot of this crazy price action with a lot of whipping around, you do really well. And again, just to reiterate, the thesis of the overnight trade we were in was that price was going to open near the 65.75, which it did not at all. The price opened 100 points down at the 64.80. But even though we were 100 points away from our center, our trade was hardly even red. Our trade was basically at a break-even point for that kind of structure. And again, the reason is that pop in volatility muted the negative price action that happened against us. And to know that that gives people a lot of peace in a way, that when they're trading these trades, that even when price action doesn't do exactly what they want, exactly when they want it to happen, they can still make money, or they're still in a position where they can manage the trade, which is exceedingly important. Had you been long calls overnight and you would have ended up in this situation, your calls would have just been devastated. And then you would have basically been at a max loss wondering, do I stay in? Do I not stay in? And even with this price action back up, had your calls been even a little bit outside of the money, they would have expired to nothing. Why? Because yes, we did close the gap, but we didn't stay above the gap very long. And then we did start to dip back into that fast move up. Let me just actually like open this up a little bit so I'm not, it's like I'm showing you guys on the smallest aspect of the chart, but the smallest size. So, we did that iron butterfly and that's like shows you this huge profit range. And even when we were outside of the range, we were basically flat on the trade. We were only $600 down. There are really no calls that you could have bought that were 1 DT or 2 DT where you would have still been green if the price would have dropped 100 points below you. And let's say very near the close, you decided, oh, I'm going to buy yesterday's high around the 66.10 and with an expectation that that Trump will say something awesome and then we're going to fly back up. That's not at all what price did. Trump said something that very much frustrated the market because it created another level of uncertainty about what was going to happen in Iran and who is telling the truth and who's not telling the truth. And we ended up with this massive gap down. Now, because of options positioning, we did end up with this massive squeeze to the upside, which is totally fine. But if your calls would have been anywhere above this little point near the 66.60, all of your calls up here would have expired worthless. You never would have had an opportunity to get out of them for any kind of money. Whereas, because of the fact that we were in an iron butterfly, this is a really important point why we trade iron butterflies. We had a profit area of $65 above us and $65 below us. So yes, we opened up below our profit range because we did open up 100 points below. But the volatility gave us a much wider range, and our wide range was almost there. So we were almost at break even when that price opened up. And so all that to say, all this time, this entire move back up, we were entirely green. We were green after the first 15, 20 minutes of the day, period. So the whole day, we are not stressed out about, are we going to get green? Is it going to come to us? What's going to happen to our calls? What do I do? Do I close them here? But I'm already at a max loss. And calls were not cheap. Volatility was so high. If you would have bought a 1 DTE, whatever call, it would have cost you $800-900. So at least. And then you would have been out the money. Had you bought it at the money, could have easily cost you nearer to $2,000. So you would have been negative $2,000 on each of your options call contracts. And if the price never breached you, if the price never came in the money, you would have been red the entire time. Now, who do you think is going to sleep better? Someone who is in a trade where even when the volatility peaks and the price drops way more than anyone was expecting, but they're at break even, this person is going to rest well. The person that is slinging long calls all the way up here and literally lost all their money because they never went in the money, their calls stayed out the money the entire duration of the day. That person should not be sleeping well. If they are sleeping well, it's either because they already made a crap load of money and they're just playing with profits, or because they don't actually understand how options pricing works. And I'm not trying to like demean the way that people trade. Listen, if you are a profitable trader over time, congratulations. You are from literally amongst a very, very, very small percentage of people. And if you are making income replacing money trading, you are part of less than 0.1% of active traders who are able to replace their income from trading money. So, I'm not here to like reduce anybody's success. If you are from amongst the few successful people in this business, so hear what I'm saying. If you are not a successful trader, if you are not making money in this market, you are part of the 90%. So you're you are amongst many, and it's okay, but keep learning. And the big thing is don't ever stop your journey on options where it comes to just trading long calls and long puts, because that is not how professional traders trade at all. And even professional traders are finding this market very difficult. We are not finding this market very difficult. Yes, there are a few days where a few of the systematics are having a difficult time. Listen, if you're expecting 100% of your trades to work 100% of the time, you are delusional and you should not be trading because statistically, that doesn't make any sense at all. There is no universe where any trade works 100% of the time and you have a 100% win rate. That doesn't exist. But what you can do is have a diversity of trades that are consistently making you good money with a very high win rate and allow you to make money over time. But I don't believe that as many people do that if they are just only trading long calls and long puts. Think the substantive number of successful traders that are doing this are trading things like credit spreads or debit spreads or multi-leg option strategies where they are able to take advantage not only of price action, but able to take advantage of volatility. And especially in a market like this, when volatility is really high, if volatility isn't part of your money making scheme, it is not, you are going to struggle because of the fact that the price action is so aggressive and will go back to being so muted that your trading strategy isn't going to be able to cope with those kinds of changes in the overall price action. Now, again, like I'm saying, there are people that are brilliant at trading long calls and long puts. Those people are few and far between, but they do very, 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 they take very, very seriously volatility and how it impacts their trading formula or their trading activity. So I wanted to leave you guys with that because I did find that exceedingly interesting. I personally like the fact that we went into the Easter weekend with an 88% return on the iron butterfly. And, we weren't in an overly stressed situation because of the fact that we just had such a wide area to the downside. Even when the price gapped way down below us, very rapidly the price came back into our profit area and we were able to make money. If you find these kinds of conversations interesting, let us know. Like and subscribe, but definitely leave us a comment because we're reading the comments and we want to create content that is interesting to you guys, challenges you, helps you feel like you are learning and moving forward in your trading journey. And if you want to learn more about how we do systematics, then hop into the Discord. All right. Bye for now, friends.